This is the most important decision that you need to make yesterday, to have the maximum amount of coverage to protect your future and everything that you want to happen.
Each financial decision is not in a silo by itself. It has to be looked at and how it relates to something else in your plan. And most people are not looking at the big picture.
So this is John Smallwood. Welcome back to Money Isn't. Today we're going to be diving deeper into the timeline of your wealth and how to protect it along the way. We're going to be hitting life insurance again because it is one of the most important foundational assets of anybody's wealth plan, regardless of whether you're single, you're married, you got 18 kids, you got one kid, you got a business, you don't have a business. This is going to apply to everybody in this because I've been doing this for 35 years. 1990 was the official entry date, licensed in 1989 in this business. And this is probably one of the most frustrating things that I deal with in the wealth management space, in financial planning, in protecting a family, is the limitations and the stupidity that goes on in the business, right? Around the concept of life insurance. And I don't really give a shit what type of insurance it is out of the gate, right? It doesn't matter the type of insurance. It just matters that you're properly insured on the date in which that bad outcome happens, right? If you're not properly insured, there's a lot of collateral damage that most likely will happen. And there's tremendous opportunity cost if you are not insured properly, meaning you may not need the insurance upon your death because you've accumulated a lot of assets, but you gave up a tremendous opportunity to have a lot more money in your family's future because you weren't properly insured. Now, I want to put this in context with different types of strategies, right? Let's pretend for a freaking moment that we own a $100 million valued piece of property that generates income. There's no mortgage, so there's no requirement for me to insure that piece of property from any of my lenders, right? And if I have a $100 million piece of property that's generating a beautiful cash flow, okay? Let's just say it's generating $6 million a year in cash flow, net after all expenses. And we go in and we look at the line items and we say, shit, it's costing us $1.5 million a year to insure this piece of property because it's in a beautiful city in a beautiful neighborhood, and it's just tremendously beautiful. And we say, the bean counters say, well, we can be more efficient and we can get rid of that insurance, or we can self-insure because you've got a $100 million building. And I drop the insurance because I don't need it anymore. Now I'm getting $7.5 million, feeling pretty good. And then all of a sudden, there's a cataclysmic event, black swan event. Something came out of left field, right field, from the infield, from somewhere, that we didn't expect, that renders the building done, leveled. So the $100 million building is now a pile of rubble. Boom. And I don't have any insurance. What am I going to do? It toppled. The ground was bad. There was a fire. Think about all the possibilities that could wreck that building. And now it's a pile of rubble. And instead of paying $1.5 million to get $100 million back to build that building back, but it might actually be more to build that building back, depending on current costs to actually do it. And I saved $1.5 million, but I lost $100 million. Does that make any sense? But that's what people do with their lives, right? Think about that for a second. The industry has trained us to focus on needs, not wants. If I owned a $100 million piece of property and it burnt to the ground or was destroyed or whatever the outcome was, I would want that building to be replaced so that I could continue that $6.5 or $6 million worth of income, right? Like, that's what I want. I don't want the alternative. Now, what's the possibility of that happening? I don't really know. But we know that there's whole departments called fire departments and emergency rescue, and there's things called storms, and there's things called hurricanes and typhoons and earthquakes and landslides and blah, 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 that affect that building. So I can't ignore the fact that that could happen in my lifetime. I can't put my head in the sand and say, well, that's for somebody else. That's not going to happen to me. Now, could you be smart with your insurance and say, well, we can get the same protection from a really good, top-rated insurance company. Instead of paying $1.5 million, we can pay $1.2 million. That's $300K a year. That's really efficient. That's good planning, right? As long as you're not giving up something in the process, right? So think of yourself as a building producing whatever income that you are currently producing. And that is the most valuable asset in your plan. And you should do everything in your life to protect that for yourself, for your family, for your business, for your extended family, for the key people that are in your business. And what I want to talk about is everything that's going to go on during your lifetime and why this is an important conversation. That is, I think there's a number that was thrown out recently. There is 100 million Americans that do not have life insurance in any form or fashion and need it. Okay? Most people that we encounter in the wealth management process bought something and have no idea why they own it, what it's supposed to do, and if it's the right amount of money. I mean, literally, nobody knows. I mean, people do. There's really a lot of smart people out there. I'm getting a little crazy here, right? But the majority of people, they go to an advisor, and the advisor says, I want to sell you something, and I want you to buy some life insurance. And you're like, oh, I don't want to buy that. That's for my spouse in the future when I'm not here. Who gives a shit? I'm not here, right? I mean, this is the stuff that I hear, okay? And I think it's really, really funny because they're not. I read a blog post the other day, or I think it was on, I don't know, it was on YouTube, and I was looking at somebody, and they were making comments on a video post, and it was like, oh yeah, I met with this guy, and he wanted to sell me disability insurance, and he wanted to sell me life insurance. And I thought there for a second, and I said, this is sad, because the guy selling didn't really understand how to sell. He didn't really understand how to communicate properly the value of the person during their lifetime. And how sad for the person to be trained by the industry. And this is really interesting, right? Insurance was created because people, when they had a loss, whether it be a building, a fire, a property loss, a crop loss, a disability, they became wards of the state. And the state was like, well, we can't afford this, right? And somebody came up with this idea of pooling resources together and saying, we're going to put this premium together, and everybody's going to pay into this system. And if you have a loss for what you're insuring for, we'll cover that loss. And that's how it started. Like, you can go back in time and, yeah, maybe I'm missing a couple details, right? But then there was these really smart people called actuaries that were created in mathematical science. And this has been going on long before AI or a computer or anything like that. And they would quantify what they perceived the risk to be based on the factors that could potentially influence. And that's how they would price the premium. And sometimes they price the premiums properly, and sometimes they don't price them properly. But they get to reprice them, right? Like, everybody's concerned about property insurance in Florida at this moment. It's gone up exponentially, and carriers have left the state because they don't want to take the risk, right? Because it wasn't in their favor. But the risk hasn't gone away. When I'm recording this, it's in July, and we already had a Cat 5 storm run through the Gulf early. The risk doesn't go away, okay? Risk doesn't go away because I have $100 million. Risk doesn't go away because I don't have insurance or I do have insurance, right? So my perspective on this is that if somebody understood that, I live in New Jersey, you can't drive a car on the Parkway and any road in New Jersey without insurance. It's a requirement. But yet, on my insurance, I have to have a thing called uninsured motorist. How the hell does that happen? I have to reinsure myself in case some schmuck that's driving hits me and doesn't have the proper insurance. Okay? But it's like, we need to have that insurance. Life insurance, disability insurance is not mandated in a wealth management plan, right? So what I want you to start to think about here for a second is, I want you to start to think about your timeline. So if you're watching this on YouTube, I've got a wealth curve set up here, and I just happen to be staying on the same concept, which is an age 35-year-old, and I'm going out to age 71. We're going to go out further, out to 100 plus or minus, but I want you to start to think about what would be the potential uses of life insurance, proper protection during my lifetime, right? Not just today. And I have this example where I have this wonderfully successful 35-year-old making $250,000 who's accumulated $400K in accounts, and he's in the S&P 500 in this particular example, and they're saving 15 to 20% of their income. Like, they're smart, right? They're on the right track. Like, this is a really successful plan. And if you look at the curve, it's like, oh, wow, look at this exponential ride. Like, hey, we're going to have all this wealth in our future. And then the needs guy comes along, right? And he says, well, you're married, your wife doesn't work, and you're going to have 2.5 kids. That's 2 kids and a dog, right? I'm just joking. Or you're not going to have any kids, right? Doesn't really matter. And they're like, okay, you have a mortgage. You need to cover this. So you might buy mortgage insurance, which is typically a very expensive piece of premium that's decreasing as your mortgage balance decreases. And the industry sells a shitload of that, and it's very expensive. And the death benefit's decreasing every single year because somehow you don't need it in the future. And I question that, okay? Now, when you look at this, I just want to pretend for a moment that I'm not putting any financial pressure in here. I don't have fees. I don't have volatility. I do have taxes and taxes on the gains, and I've overwritten this at 37% for ordinary income, which is high for a 250 earner, and capital gains at 20. And when you look at it, right, if I come in here and I look at these pressures, if I put college into my wealth plan and I say, at 50, 15 years from now, my kid's going to go to college, and in today's dollars, that costs $75,000 for the schools that I'm dreaming about that I want my kids to actually go to. And at 4 years, hopefully it's 4 years, not 6, all right? We had that recently on a podcast. But here you see, hey, at 49 years old, actually it's not 49, it's 50. At 50, the curve starts to take a little bend and it comes down. And college costs 1 year, if it costs $75,000 today and the inflation rate is 4%, guess what the first year costs? $155,000. No effing way. Now, when my first kid was born, top schools cost $35,000. We projected it with the data that we had. We thought it was going to be about $55K. It was $65. And by the time the last kid's out, it's $85. Okay? And college is going to be different. College is going to be free. College is going to be done. But so in a perfect world, if I died right here, I would want to say, I want to take 4 times 8, 80, 4 times 75, take 300,000 and just put it in account earmarked for college. And then I want to take money and I want to pay off my mortgage. And then I want to give my spouse enough money to replicate my $250. And then I've got $500,000 of insurance because some needs analysis said I only need $500K because that's what my mortgage was. So what does your wife have left? What does your spouse have left? What does your non-working spouse have left? Nothing, right? So you run this really, really quickly and you say, death age, 36. And there's no insurance. And I come in here and say, oh, let's put some cheap term in here. Boom. And it only lasted at 46, flat broke. With just a half a million. There's no mortgage in here for this one, okay? So my point is, I don't know what's going on, but I want you to think about this, right? So I started to think about the timeline, and I started to think about all the potential things that I could use the insurance for during my life and all the financial pressures that I may have. So I have college, I might have a second college, I might have a third college, I might have a fourth college, I might have private high school, I might want a car for that kid. I have shit happens in the house pressure. Wasn't expecting that to happen. Brother-in-law needs extra money, right? Needs to borrow money, which I know I'm never getting it back, right? Never gonna happen, but hey, I gotta give it to him because he needs it. I might want to join a country club. Mom and dad need nursing home assistance. I see this all the time. People in their 60s paying $3,000, $4,000 a month, which is destroying their financial plan in itself, regardless of how much money that you have, okay? Because now you have opportunity costs because mom and dad didn't do good planning, okay? Lawsuits, long-term care, failure to launch. I got a kid who hasn't launched. You might have a kid that hasn't launched, right? And you're spending money on them in retirement. You're helping them out with their mortgage. You're helping them out with their stuff. Or I got an un or underinsured property and casualty loss, right? Things that I was talking about, right? But here's the thing. If I think about the uses of life insurance in my current need, then I start to think about all these future obligations that I want to have happen. If I'm gone or if I'm disabled, none of that stuff happens. If I'm disabled, that means it's actually worse because I get to see it while I'm alive. But then I think about the timeline, and you start to expand the timeline out, and you start to look at this and say, well, what if I have volatility adjusted returns? What if I expand this out and say, oh, let's take this out to 23. Let's go longer time frame here. I'm looking at data, 1965 through 23. And then I've got, inflation at 3%. Oh, that didn't work. So you got inflation at 3%. My salary went up by 3%. And I'm getting out here and I'm getting, everything seems really good, but then I have all this pressure because I didn't do a good enough job of savings. And then I start looking at this and saying, oh, I got a long-term care cost. I got all these different things that are happening during that timeline that could potentially be negative. But it could, like, I could actually have this happen by 10%. My income could go up. I have no idea how much money I'm going to be making 10 years from now. If I'm a business owner, I have no idea. So think about the timeline. I've got family needs. I've got income protection needs. I've got future liabilities, obligations, things that I want to fund. I have special needs, children that I might need to put money somewhere. Let's say I'm really, really successful and I have a family business and I have 2 kids and one kid never enters into the business. But one kid comes into the business and takes the business from its current successful thing and grows it to this massively successful thing. And then my spouse and I die, and our will says, split the asset in half. And now the kid who drove the business has to take care of his sibling who didn't contribute anything to the business? That you have no idea how often that freaking happens, okay? But a simple piece of life insurance to equalize the estate could have simply said, business is worth $10 million, kid not in the business, we want that person to get, we want the kid in the business to get the 10 because they're helping us do it, and we want the other sibling to get $5 million, which would be 50% of the estate. And you buy a specifically dedicated piece of life insurance that says, upon my death, give that person $5 million. We have our IRAs, our houses, and then we split that equally between the 2 kids. Because what I see happening, and you know this, if you're listening to this and you are successful, you know this is happening in your plan and you don't know how to solve it, right? You have to equalize the wealth and you don't feel like you can give it both ways. So all it does is create havoc and bullshit in the household, right? Everybody hates each other now because I literally have encountered this in my financial life, not once, not twice, a lot more, okay? And what's interesting is, so you have people in the business collecting a check who don't contribute to the business, and they're getting literally $500,000 a year in distributions, and the people that are running the business have animosity against it, right? They lose their incentive to go do what they want to do. And it's very simple if we really think about what it is. Now, I'm going to go back to my $100 million beautiful building for a second. And I die, and my wife dies. And within 9 months, that $100 million building today with a husband and wife each have $13 million exemption, could sunset, could not, right? Don't know. But that exposes roughly $75 million to inheritance tax, which means within 9 months of date of death, my children need to write a check for $45 million to cover the inheritance tax, give or take. Doesn't matter. The concept is what matters, right? Where are they getting the $45 million? Well, the building's producing $6 million. I either sell it really quick or I leverage it. But if I had $45 million worth of insurance or $100 million, 1 times the estate, family gets all the asset and more. But the life insurance got to be part of an overall plan. Everybody's perspective is that life insurance is going to kill me from a financial perspective. I'm going to lose money. You hear buy term, invest the difference. You hear don't buy whole life. It sucks. Don't buy universal life. It sucks. This, that, the other thing. It's all opinions and biases, and I don't want to do it, right? So now you start thinking about, we got estate equalization. We got estate maximization. We've got providing liquidity in the estate, right? Then we're talking about in retirement, most people, we are taught that we do not need life insurance in retirement. And life insurance in retirement is probably one of the most valuable assets. But yet people in the industry are trying to shove all your money into the life insurance, which I believe is not in your best interest, okay? We don't want all your money ever in one asset class because you lose the value of the death benefit. But if I talk about retirement is short for some and long for many. And during that time frame, there's many possible outcomes. Medical expenses for the average person in the United States, this is not including long-term care costs, medical expenses unreimbursed will cost $250,000 over a normal retirement, which goes to $87,000. Husband and wife, that's $500,000 average. Is that going to erode your capital? If I have that and end up in a long-term care facility, I'm going to spend money down. When you think about life insurance for a second, it's the only thing on the timeline that I know that's going to happen. I don't really know if I'm going to pay taxes or not, right? I don't know how long I'm going to live. I don't know if I'm going to be successful or not successful. I'm driving myself to be as successful as I possibly can. But death is the only thing that I know. Somebody said death and taxes are the only two things that are constant. I think death is the only thing, right? And the question is, what happened prior to death? Like, if I went into a nursing home and I spent half of my family fortune down in the nursing home and dragged it on forever and ever and ever and sucked everybody dry, and I die, and there's no replacement asset, the person who's surviving and or the family doesn't get the money, the corporation gets that money. The nursing home, it's a corporation. It's after your money. It wants to take it from you, okay? That's what they do. Now, if I have a bunch of life insurance, there's accelerated benefit riders on those, which means I can access the death benefit prior to death for terminal illnesses or chronic illness, depending on the company and the strategy, right? I can put a long-term care rider on it. Or I can just say, who gives a crap? Upon my death, we'll get $1 million back, which I burnt up $1 million. We get $1 million back tax-free from the life insurance structure, right? Now let's talk about business owners. Buy-sell agreements. How many people listening to this podcast right now own a business with 2, 3, 4 partners, and they do not have a valid buy-sell agreement that is properly funded? You can either have it funded or unfunded, right? So we have a building that's producing the $6 million. Let's just say we have a business that's producing $6 million, and there's 3 partners. So the 3 partners are making $2 million. Upon the demise of the first person in that structure, you have a $33 million liability, assuming it's worth $100 million. Your partner's dead, and some people want the spouse to come in because the spouse is a better business person. But the majority of the people that I talk to do not want the spouse in the business because they're not a good business partner. But now you got to pay the business partner out. And you got to pay it out of current cash flow. And it's going to cost you $2 million a year for a very long time to pay off the $33 million. It's actually going to cost you more. Now, how are you going to finance it? Are you going to finance it for, 10-year payout? $33 million on a 10-year payout, it's $3 million a year without interest, right? Just do the math. Simple math, right? And Am I going to fund it out of cash flow? Or do I take small amount of money and buy a $33 million policy and pay it off in a lump sum? There's so many nuances on the buy-sell. You could have key man insurance. You have somebody that's an absolute star in that group, and that person is the person who died. You have to replace that person. You might have covenants on your document that says, hey, we have these loans. If this person passes, we got to pay these loans off, right? That happens all the time. You could use life insurance without coming into ERISA and other related things for deferred compensation and selectively choose who wants to be in. You can do what's called a split dollar. You can say, hey, Johnny, if you work here for the next 10 years, we're going to put $20,000 a year into this, permanent insurance policy that when you retire, you're going to get X amount of dollars in. But in the meantime, your wife has an extra $1.5 million worth of coverage in the event that you pass away. There's so many things that you could be doing, but the business, it's like the business has its own internal needs for the key man, for the buy sell. But then in the person's estate, let's say they got the $33 million estate. And now they're passing, there's a buy sell giving $33 million in the estate, but their estate's worth 50, 60 because they were really good savers, but they don't have insurance over there. Now there's 15, 20 million of inheritance taxes. Right? So you start to think about inside the business, outside the business, what are the reasons for having insurance? Now, successful people who are worth a lot of money buy life insurance. But we're taught that we don't need life insurance when we retire. But why do successful people buy it? So I want to talk about the concept, which is in retirement, we are taught that the death benefit is useless to us in retirement. And I want to talk about how do I spend death benefit while I'm alive? People don't understand that it's not viatically selling my policy to a third party, because you can sell a policy to a third party. We hear the ads all the time. I didn't know my life insurance had value. Right? That's the inflection of the person. It's a great ad. But they're basically, you have an option. You have a term life insurance policy. You can't afford it anymore. It might be convertible. It might not be. We're going to do a whole thing on that. And they can convert it, and they'll say, oh, you got the $1 million policy. We'll pay you $100,000 for it. The policy has zero cash value, but you're getting $100,000. Oh, I'm going to take that. Now you got a black car following you around all the time. Just joking, right? It could be a really good strategy for you. But they know actuarially, why are they buying it? They know you're going to pass. And if you pee in a cup and take blood, which they will make you do before you buy, and they go, there's a thing called an LE, which is a life expectancy. And they know you're going to die within 6 years. It might be 10, it might be 2. And they're going to buy 1,000 policies. And they're taking the actuarial assumption that we know out of 170-year-olds, how many are going to make it to 80? Not a lot. Don't know the math, doesn't really matter. But the actuaries know exactly what it is. So they're willing to pay for that insurance that you want to get rid of. That's nuts to me. Okay? Now, I could have a policy that has significant cash value and a significant death benefit. I can turn it back to the insurance company and get the cash value right when I'm gonna die. But I can sell it to a third party for more than the cash value. That's pretty freaking powerful. Why? Because actuarially we know it's gonna happen. But I want you to think about it is, if they're willing to buy it, why are you willing to get rid of it? Think about that for a second. Everything that we do here is thinking about your thinking. You need to be strategic when you're thinking about your financial plan. I don't know what your future holds. I don't know what my future holds. I have goals, I have dreams, I have vision, I have desires, I make actions, I take actions, I'm doing things, but I don't know really how successful I'm going to be. And I don't know how unsuccessful I'm going to be. I don't know what shit is going to happen along the way, right? I don't know. But I do know this, that if I take really good care of myself in my wealth plan, and I focus on maximizing protection with the least amount of cost and maximizing my investments, the probability of success is actually higher. And when something goes wrong, I have a backstop. I've insured the potential problems. I have a higher probability of making it through a crappy time. Okay? But let's talk about retirement for a second. So I have I have $1 million saved up for retirement, and $1 million. You hear the comment, "You look like $1 million," and I think that's a freaking insult today. Why? Because $1 million is worth like $40K a year. When I started in the industry in 1990, it was worth $90K. That's not even inflation adjusted, because in the bank, I could go and put it in a 9 to 10% CD. I could put $1 million, I could get $90,000. $90,000 in 1990 was very valuable. 34 years later, I'm going to make 5 right now. And 18 months ago, I was making like less than 1. So you look like $1 million is actually an insult. I think you should say you look like at least 10 million, maybe 50. And if I'm talking to my wife, you look like $100 million and maybe $1 billion. Okay? Because I don't want to insult her. But that's what we're thinking about, right? It's like I'm on this ride, and I'm looking at this and saying, I got to a point where I'm going to retire, and I have a house that's paid for. I have $1 million or $2 million saved up. I have some Social Security, and I have a pension. And I have a lifestyle and expenses. And you go to an advisor, and they're saying, how long do you think you're going to live? Do you actually know how long you're going to live? You could live one day. You could live to 120. You could live to 105. You could live to 85. You could live to 95. And then what they're telling you is you really shouldn't take more than a 3.5% to 4% withdrawal on your money. Now, I've done some other podcasts talking about that and how that works. But if I have $2 million and I take 4%, it's $80,000 pre-tax. Is that really going to hit your lifestyle budget? Is that going to be really, really successful for you? Or are you going to be, do you really want 100,000? So my point is, if I have, let's say that I have the 2 million, I got the house that's paid for, and let's round up, I got $2.5 million worth of hard assets, Social Security, and a small pension. What's my biggest problem in retirement? Which one do you want to pick? I've got inflation. I have changing tax rates. The sunset is ugly for people making about 130,000. The sunset in 26 is ugly, even though you get your SALT deduction back. It's going to increase taxes. I did something recently on this by about 15 to 20%, which is going to increase your withdrawal by 15 to 20%. And that's going to speed up the probability of running out of money. So inflation is here. Taxes are changing. Volatility adjusted returns are constantly changing. If you're looking at my screen, this is 100% in the S&P 500, right? And I'm looking at the data, and you've got some major downturns in here. But, that's because we had this 10% salary. I'm going to get rid of the 3%. I'm going to get rid of this and bring it back to a more smooth ride, bring this back out, which is nobody gets this smooth ride, but I want to give you the exponential side of this, right? Which is, what's the number one thing that I want to do in retirement? Number one, I want to enjoy the first 15 years of my retirement. Like, I'm 65, I'm 70. The first 15 years of my retirement, I don't care if you're 35. The next 15 years of your life is the most important 15 years of your life. It's where you set your habits up right. It's where you do everything. But that's where I want to travel. I've been deferring enjoyment. I want to do stuff for my kids. I want to spend time with my grandkids. I want to do these things, right? But the purpose is I want to preserve my $2.5 million because I don't know how long I need that money to last. I don't know what inflation is going to be. I don't know what the tax rates are going to be. I don't know what the rates of return on my money are going to be. I don't know what my health care costs are going to be. There's potentially Medicare cost regulations coming out where the free Medicare premiums that people have, the Medicare supplement premiums, could go to be unfree. What kind of impact would that have? What kind of technology is coming? Like, nobody that retired in 1990 needed a cell phone and a data plan. You had a cable bill that you thought was expensive. Now it's, what, $300-400 a month that we didn't have, right? There's factors that you're not factoring in. There's planned obsolescence. My grandfather retired and bought the Oldsmobile Delta 88 in 1978, and that was his retirement car. He had 3 cars, lived into his late 80s, but he thought, oh, I'm retired. I'm going to have that one car. When he started, paying into Social Security, the promise was that wasn't going to be taxable. He's like, now it's 85% of it's taxable, right? So the purpose of what I'm trying to do here is say, because I don't know the variables, I don't know if I'm going to end up in a long-term care, I don't know what's happening, I'm afraid to spend my money and enjoy it because of my strategy. And what we look at is the life insurance death benefit is a spendable asset in retirement if I am creative. It is a permission slip to do things that other people won't do because they're afraid of running out of money or disinheriting their family. I mean, I don't like it. What you want is what we want, right? You may not want to give your family a lot of capital because you didn't start with any capital, but you're not your parents, right? So possible ways to spend the death benefit in retirement is, let's assume for a second I have $2.5 million of death benefit paid for, and I got $2.5 million of assets. Instead of taking a 4% withdrawal from my $2 million portfolio, there are things that I can do that are going to increase it. I could do a reverse mortgage on that $500,000 house. 70-year-old couple might get $25,000 a year tax-free. On an $80,000 distribution, an extra $25,000 tax-free is massive. The life insurance replaces the value of the house. Do the kids really want your freaking house? Unless it's really, really nice. But I'm assuming it's $500,000 somewhere in a retirement village. No, they don't want that. Okay? But if it's in Portugal, maybe they do want it, right? I don't know. I'm just having fun here, right? But that extra $25,000 tax-free is massive. What if I said, hey, I'm going to split my $1 million, keep $1 million, and take $2.5 million, and take the other $1 million, and I'm going to do an annuitization. I'm going to go to an insurance company and get a guaranteed lifetime income of, $60,000 a year from the $1 million asset. But I'm exchanging the $1 million to get $60,000 a year joint life income between my wife and I. When we die, the insurance company keeps that money, but we got $60,000 in perpetuity for as long as we live. The life insurance replaces that back into the estate. Let's assume for a minute that I've decided that I want to sell my $100 million property earlier, right? But the capital gain rates are 55% plus New Jersey, plus your state. God, I can't freaking sell that thing. If I sell the $100 million and my accelerated depreciation gets all recaptured, and then I got to pay the higher capital gain rate, and I'm going to walk away with $30 million. But what if I did a charitable remainder trust? And I said, I'm going to gift the property to my favorite charity, and they're going to sell that building, and I'm going to get a massive tax deduction for making that charitable contribution, which will offset other things. And now I'm going to get a 5% lifetime income off of the $100 million. $5 million versus the $6 million. But I have $100 million worth of insurance, or $30 million, because the family was only going to get $30 million if I sold it. The permission slip is I could do that, and I don't have to worry about owning the piece of property. I could do a pay down. I could use the death benefit to collateralize things. If the policy has cash value, I can use it as a volatility buffer. We know we're going to get this volatility adjusted returns. And if I happen to be withdrawing too much in one of these down markets, I could run out of capital. Like if my lifestyle is going up by 3% in these down markets, I get an outcome like this. And now all of a sudden I'm not taking out, I'm cutting my lifestyle. I'm selling everything because my lifestyle is now $522,000. I got to figure out how I get it back to, the inflation adjusted back over here. Right now, I need 150. At just 3% inflation, at 80, I need 522 to live exactly the same way I am today, right? So you start thinking about life insurance and say, I have business uses, I have personal uses, but the most important part of having life insurance is the element of retirement because of I could have a pension. Here's the thing that I think might be the stupidest thing that I see out here. And teachers have this, and people retiring. And because we didn't have good planning up front, let's say I'm going to retire from a company that still has an old school pension. And I'm going to get $100,000 a year. Let's just make this math really, really simple. Life only. My wife, my spouse, needs to sign off on this if I'm checking off life only. That means I get $100,000 a year, but if I die, she gets nothing. So many people did that. And that's why the law says now your spouse needs to notarize the signature that it's actually her signing this that said you're okay with that. But now your wife is either the same age as you, she's either older or she's younger. If she's older and you're actuarially the same age, the payment gets a little bit not as bad. If she's younger, the reduction in the payment's going to be even less, right? So let's say you're the same age. And I want a joint survivor that pays her 100% or him 100% of the pension when I'm gone. Because she's going to live to 120 and I'm going to live to 85. You hear that all the time, right? So the calculation basically says if we'll pay you $85,000 a year, and upon your death, we will give your spouse $85,000 a year. If she predeceases you, it doesn't jump back up to the 100. You're stuck at the 85. What is the $15,000? That's a premium for life insurance. You're spending $15,000 a year in retirement to cover your spouse for the $85,000. But if I had the $2 million worth of life insurance, I could take the $100,000 pension option because when I die, she gets the $2 million. And we have the benefit and the enjoyment of spending $15,000 more per year on a guaranteed basis. When I die, Social Security, my wife has to choose hers or mine. You get to keep, Social Security, whole thing that goes on, right? That people don't really get. But I'm painting a picture that I could use the death benefit to collaterally assign to a nursing home that prevents me from spending my current assets. Most people don't even think about this. I could use the life insurance cash values, if they have cash values, to supplement my retirement income completely tax-free. That doesn't throw me into the IRMA calculations. If you're in your 60s, you know what IRMA is, right? Earned, it's your earned income. If it goes over a certain spot, your Medicare goes up and up and up and up and up, right? Your Part D or whatever it is coming out of your Social Security payment, right? So my argument here is that life insurance is part of your entire plan. If you're successful, you actually need more, which is the exact opposite of what we're taught. We're taught that we don't need it. And the industry somewhere in the 70s this guy came out with this thing called the needs analysis. And all of a sudden it came down to, and I want to go through the stupidity of this for a second. Okay, Mr. and Mrs. Jones, you're 35 years old, husband makes, wife makes, whatever it is, $250,000. You have a $500,000 mortgage. Interest rates are 10% in the bank. Inflation is 2%. And you have to put some money away for college. And college, Bentley College cost $15,000 my last year. It cost $7,000 my first year. It's now $7,580. Okay? And we do this capital needs analysis. And I'll probably get a lot of hatred for this, right? Because the industry works on this. And this guy comes in and he says, you actually need, for all of this, $1 million. Because that's going to give you $100,000 per year. And then tax rates go up, interest rates fall. Inflation is not 2, it's 6. Does that plan work? So, as I started this conversation, what is if I died yesterday and Sharon got a chance to come into the office today and say, the life insurance company was here and they said, oh, Mrs. S, this is really great. You get to choose how much insurance that you need today. You get to choose the death benefit. Just tell us, we have an open checkbook with whatever you want. Are we going to do a needs analysis? Or is she going to say, well, let's make this pretty simple. Give me the maximum. And what is the maximum? So in that particular case, a 35-year-old making $250,000 might be $6 million. $6 million of death benefit gets the person to go to where all they want to go. And it has enough money to go through bad winters, right? Times when the markets are sideways, times when things don't work well, when expenses are higher. They don't have to get remarried. They don't have to do stupid things, right? They don't have to do anything. They're living, your kids are they're getting to go to college. They're getting to live their dreams. Mom keeps rewarding and giving through this thing. Like, if I go to your funeral, it doesn't matter what the type of insurance was. It just matters that somebody's walking in there with a check that's going to keep the family in the same exact spot, and that the assets pass properly and the business is done right and the business continues and everybody's sad. But 6 months later, the only thing that matters is what is the stability of the family. You are forgotten. You are, okay? But you are thought of either negatively or positively. If we're in financial crisis, that bastard, okay? If we're financially successful, your father was really smart. Your mother was so smart that we did this, right? So the only solution is maximum. What is maximum? If you're 80 and you got $15 million, and you're not working, the maximum is $15 million. If you're 60 and you're worth $100 million and you're making $6 million a year from other business and other ventures, you're probably worth, your insurability is probably $160 million. How do you acquire that? That's the creativity. That's the way it happens. But I want you to, this was a long presentation because I wanted you to think strategically about the timeline. And I want you to, you can ask us we have a wealth curve pressure identifier conversation that you can sign up for, but we also have a booklet. We can mail it to you. We can email it to you in a PDF format, right? That says, let me sit down and go through all the dreams and visions that I have for my family. Where's my future going from my income perspective? What's my tax rate? Where am I saving money? What's my debt structure? What's my lifestyle like? Where's my current assets? What's all the future shit that I want to do, and the cars and the boats and the dreams and the country clubs and all the stuff that I want to do? And then how well am I protected? And you're going to know whether your plan is right or wrong. The whole purpose of the conversation or the book or the worksheet, because we got a worksheet, we got a book, we got all this cool stuff, is for you to think strategically about what you want to do and how you want to invest and secure your future, right? That's the purpose of the conversation. And we as an industry, whether you're in wealth management, you're a certified financial planner, you're a chartered financial consultant, you are a RIA, to ignore life insurance and bring it down to opinions, biases, and hearsay is a detriment to your clients. If you're listening to this, you need to do a better job as an advisor, okay? If you're listening to this as a client, you need to get yourself, if your advisor isn't giving you macro view, he isn't giving you a blueprint and saying, how well is your defense, Johnny? And they're ignoring the life insurance, they're ignoring disability, they're ignoring long-term care, they're ignoring wills and trusts. I mean, I hate to say it, I got, yesterday we met with, an 80-year-old on a referral, 80 plus. No wills, no trusts, 5 kids. WTF? Seriously. No insurance, nothing, but a lot of assets. A lot of illiquid assets that potentially have value in the right hands, potentially don't have value. Here's what my point is. If you don't get really good advice, macro, you don't have a really good long-term wealth plan. If you do, then you understand what you own, why you own it, why you bought it, whether it's convertible, how long it's convertible for. And I'm going to talk about term insurance. There's a shitload of options. There's whole life. There's universal life. You can finance a premium. You can pay for it out of pocket. You can have an increasing premium. You could have an increasing whole life premium. You could have a decrease. You could have second to die. You can have life insurance in a trust. You can have life insurance outside of a trust. It's ridiculous the amount of options that you have. But the key is you got to look at the big picture and go big picture and understand what this is about. So this is the most important decision that you need to make yesterday. To have the maximum amount of coverage to protect your future and everything that you want to happen. Great conversation. Truly appreciate you. If you're still here, share this, like this, hate it, whatever you feel most comfortable with. Talk to you soon.